Hello and welcome everyone to the Equitymaster Investor Hour. I'm Sarit. I have with me Rahul and Vijay on the podcast today. And we are happy to have Vijay back again because today we want to talk to him about quite a lot of things actually. He was on the podcast a few weeks back talking to us specifically about gold. But today we want to broaden the picture and get Vijay's views on quite a lot of different topics, especially now that the markets have started
Yep.
falling. And Vijay has been a proponent of that view that the momentum that we have been seeing in the market is not sustainable and a correction could happen at any time, and it has happened. So, Vijay, thanks a lot for joining
Yep.
us again.
So, sorry, if I can just add before Vijay steps in.
Yeah,
Uh, for those of you who are new to the Investor Hour podcast, Vijay Bhambwani is what we call and what we believe, and many people agree with us, he's really India's number one trader. He's been trading for over 30 years, 35 years. Vijay, can you correct me on that?
34 since
34 years.
1986.
1986, there you go. So he's been trading for that many years, a self-made man, has been running his own sort of trading business all along. And a couple of years ago, he partnered with Equitymaster to bring all that insight and learning and offer it to our readers. He heads up what is called the Fast Profits franchise of Equitymaster. It's what Sarit said very rightly is that we're going to have a broad discussion today. And before sort of we welcome Vijay, I want to remind those of you who've been listening to us that in February 2020, we did a podcast with Vijay talking about the COVID. And it was, I think, an eye-opener for everyone who attended it because uh, if I recollect well, Vijay even called that everything would fall, including gold. And truth be told, in the first 15, 20 days, gold did fall, right? Because people wanted cash. They sold whatever they could. And then I think Vijay came back to us on the podcast in the end of March, maybe. And he was speaking about how we need to wait for the quarter to get over because the quarterly adjustments are there. And he got the rally bang on. And that was, I think, for those of us who were listening to Vijay at that point in time, that was an eye-opening experience. I don't know of anyone who got the call right, both on the downside and the up, right? And and after that, I think we just kept getting Vijay on because he was so much on the ball on exactly what is happening. Uh, if I can share one more example, Vijay has been long gold for his readers at Equitymaster. I'm going to say since October or September, October 2019, if I'm not wrong on that. And he rode the whole rally. And then he effectively put out an update that it's time to book profits. And that was at the heat of the moment. Gold was, I'm going to say, $1,950, $2,000. Silver was probably $26, $27. And he said it's time to take money off the table. And he asked people to, I think, book profits. And well, I think that was 3 weeks back. Uh, Gold and silver have struggled. The other day, we are recording this on a Wednesday, and on Monday they fell off. On Tuesday they fell off, and the gold and silver prices are way off where they should be, exactly how Vijay called it. So if you are someone who's interested in the market, if you are someone who likes to time, who likes to be like trying to time the market well, then you must listen very carefully to every word that Vijay speaks on this podcast. So now to cut to what Sarit was saying, Vijay, welcome to the Investor Hour.
Thank you, Rahul. It's always my pleasure and privilege to talk to Equitymaster viewers. And it's always, I always look forward to being with you and Sarit on this podcast. So thank you for having me.
Thank you. It's pleasure's all ours. Sarit, kick it off.
All right, Vijay, thanks once again for joining us, and let's get this started. Your view on gold, if we can start with that, since you spoke about it with us just a few weeks ago. You said that gold and silver are showing a lot of strength, but there could be weakness, before the U.S. elections. I think it would be good if you could just, kind of broadly elaborate on your view right now, because a lot of our viewers may be listening to you for the first time, maybe for the second time. They like a broad picture once again on precious metals.
Well, Sarit, my view remains constant. I still expect a lot of alpha or sheer capital appreciation from both gold and silver.
Mhm.
Maybe a little more from silver than gold because silver tends to surprise where appreciation is concerned. It moves in snatches. Like the proverbial Kumbhakarna, it goes to sleep for extended periods of time and then makes up for everything in maybe 1 or 2 quarters.
Mhm. Mhm.
But election time in the US is typically bearish for both gold and silver because the US Fed sort of gravy addresses the economic numbers, the data, strengthens the US dollar, which automatically means bullion has to fall because the dollar is the invoicing currency. You basically settle international trades in commodities via the US dollar as the default payment currency. So if the currency is strong, the commodity falls. So the US dollar is deliberately strengthened ahead of the election. The stock market is pushed higher, and therefore gold comes down because people see a less of a threat perception. And gold, as we know, is a safe haven, a store of value. So people are basically given a feel-good factor in financial assets, which is why gold tends to underperform before the US elections. What I said in my earlier podcast remains true even now. All the unbacked printing of fiat currency or paper currency will come to bite the US and the global economies in 2020, which means that currencies will depreciate and commodities will appreciate. So come 2021, and I'm not saying that a rally will start from 1st of January 2021 at the stroke of midnight, as you say, Happy New Year. It takes a little while in coming, but then gold and silver are a patient gentleman's game. And given enough time, you can be actually surprised by the returns that you get in bullion. You might even be able to outperform what you've seen in equities many a times. Just take, for example, what Rahul said some time ago. We latched on to gold in the physical segment via the week-ended newsletters for the weekly cash alert subscribers in June 2019.
It was June. Okay.
Silver doubled from there
Mhm.
by August 2020, and gold went up a whopping 65%. Now, that's the kind of return that you expect out of equities, not from bullion. But
Mhm.
sometimes elephants can and do dance. And gold and silver are ready to do this dance again in 2021. And my last podcast, I gave out 60 to 60,000 target for gold in 2021 by December 2021. I'm willing to stick my neck out and say it still holds.
Yeah. So does that mean, Vijay, that there may be a prolonged buying period in gold as the election happens in the US?
I think so, yes. I mean, you could see a lull period for a fairly extended periods of time because
Mhm.
people have unfortunately built up a lot of expectations. And in my last podcast, I talked about how Robin Hood traders differ from the mindset that veteran traders have. Veteran traders tend to look at the trading and the investing game like a game of chess. You are allowed 45 minutes time interval before you move each and every piece on the chessboard. Now that might look boring to a lot of people, but that's the way grandmasters play. The younger generation basically says, look, I entered into a trade at 16 minutes past 9. I want my money at 17 minutes past 9. It doesn't quite work that way.
Mhm. Mhm. Okay. So, so prolonged buying opportunity. So for the listeners, if you are underweight gold, you have a few months to get in, and then as Vijay expects, the gold and silver could do very well. So I have two questions related to that. If one had to make a choice, from a, let's say, a 1-2 years perspective or a longer term perspective, gold versus silver, what would you pick?
I would say you should have a minimum of 40% of your capital in silver and 60% in gold. I'm saying 60-40 in favor of gold, not because I have any less expectations from silver, but gold tends to give you fewer downside shocks as compared to silver. Silver can, as you've seen, you likely rightly pointed out, Rahul, in the month of March, everything suffered a meltdown.
Mhm.
When I saw the price of silver sub 38,000 and then sub 36,000, I mean, what? Silver sub 36,000? It was really crazy. But then it bounced all the way up from sub 36,000 to 70,000 plus in double quick time. Now, that's the kind of volatility older guy like me would like to avoid. I want to enjoy the process of making money as well as the end destination of a profit. So if you're looking at volatility and you have a very strong stomach, maybe you can even go to 50-50 where gold and silver is concerned. But if you want to lie back a little, put your hands behind your head and enjoy a TV show and have a cocktail, gold 60%, silver 40%.
I find that approach very interesting. But my question was one of the two, but I think what you are saying is so insightful that even when it comes to bullion, you should take a portfolio approach as against just put all your money on one horse, if you will. That's I think that's pretty insightful, and I think that's an approach that sort of I've not really thought about, but the more I think about it, it's a far better approach. That's what we do in stocks. We keep telling people not to put all your money in one stock, right? You have some large cap, you have some mid cap, you have some small cap, and that's what you're doing in bullion. I think that's a great idea. The related to this was my second question. Was your favorite what you introduced us to it? We never thought of it that way. The Dixie. The Tell us about the Dixie, and in today's context, the Dixie seems to be more important because in the last couple of days it's just shot through the roof, and maybe one of the reasons why gold and silver are taking a knock.
Well, the Dixie is nothing but the US dollar as an index against the global basket of currencies. So what you're basically measuring with the Dixie is the strength of the dollar vis-a-vis the other global currency basket.
Mm-hmm.
So if the dollar goes up, the Dixie goes up vis-a-vis the other currencies. And the US, as the world's largest debtor nation, manages, I would say manage into inverted comma, its external debt by way of strengthening the dollar.
Mm-hmm.
The stronger the dollar becomes, the less the US has to pay by way of interest and in principal, which is why they basically give you such poor rates of interest.
Mm-hmm.
So the return on capital for a creditor of the US is very small, which is the interest. But the return of capital by way of capital appreciation is big. So if you were to give a loan to the US at a price of $60 vis-a-vis your currency, and the US pays you 0.25% interest, which is actually next to nothing. But what you're actually expecting is that by the time you get your money back after 5 years, the dollar will be 70, so there's capital appreciation. So return on investment versus return of investment. The US dollar is all about return of investment.
Mm-hmm.
Now, it's a standard operating procedure, and I've recorded a couple of videos for Equitymaster that before a US election, there's actually a system called the presidential cycle.
Mm-hmm.
There's a standard operating procedure. Stock markets are pushed higher, real estate markets are pushed higher, and the dollar is made stronger. Hey, that's how the US manages its inflation and its debt. So, which is why I say that gold and silver probably will remain subdued ahead of the US elections, because the US is likely to strengthen the dollar. Like I just said, the dollar is a global invoicing currency for the commodity markets, and the stronger the dollar, the weaker the commodities.
Yeah. And the Dixie is going up these days again. It could be many reasons, but the presidential cycle is playing out exactly as you said in front of us right now.
The Dixie is going up because the US Federal Reserve wants it to go up. The US President wants it to go up.
Mm-hmm.
And if you actually Google search, and thank God for Google now, there's so much data available for free out there.
Mm-hmm.
If you actually search Google,
mm-hmm.
whenever real estate prices have fallen and the US dollar has fallen in the term of an incumbent president, the public has voted him out. Because a home is what a US investor considers his ultimate investment. That's the only investment. For day-to-day living, these guys are living off their credit cards, maybe 6 of them, not just one credit card. But the home is the final bastion of investment that an average US citizen has. If his home prices are falling, and if the dollar price is falling, which is what results in inflation and joblessness, the guys boot the president out. So, which is why the president wants a real estate market and the dollar to go.
Yep. Great. Sorry.
On that related note, Vijay, how does this flow into the rupee? I mean, if the dollar is getting stronger, is there a likelihood the rupee could fall? I mean, in one of our podcasts, I believe you said there's a chance that the rupee could go all the way to 80. Do you see that happening?
Sarit, long period average or LPA, the Indian rupee has a tendency to fall 3.5% to 5% per annum. I'm talking of a long term. I don't think that a correlation is likely to snap anytime soon. Let's not forget that the US dollar index, the Dixie, was close to 100 a couple of months ago, and it fell below 93 for a fairly prolonged period of time, which is why you saw the USD INR go from 76 plus to almost 73. So people attribute it as a strength of the rupee. I think it is a weakness of the dollar. These are two different things. You're not getting stronger. The currency with which you're benchmarking yourself is going weaker. Now that the US dollar is getting stronger, I have a feeling that the USD INR might just bring an unpleasant surprise on traders. There is a possibility, if especially the USD INR starts trading consistently above the 74.25 or 74.5 mark, it could simply zoom up. This is something that I noticed on 13th of August. I remember the date, 13th of August 2018. The dollar simply jumped up by 1 rupee and 8 naya paisa in one trading session. That's never happened. When the dollar on an average day moves between 18 to 23 paise per day, on that one day it simply exploded by 1 rupee 8 naya paisa. I do have a sinking feeling that such kind of big moves, not necessarily 1 rupee and 8 naya paise, maybe 60, 70, 80 naya paise might just be in the offing.
Yeah. What's your long-term sort of number for the rupee vis-a-vis the dollar?
Rahul, I don't expect the rupee to strengthen beyond the 71.5 level. Let's not forget worldwide the economies are in a race to the bottom. This is also called a currency war. This is also called beggar thy neighbor philosophy, wherein you devalue your currency faster and harder than your neighbor to compete in the global export market. So I don't think the rupee should appreciate beyond 71.5, give or take a little, but it has the potential to depreciate all the way up to 78 or maybe even slightly more.
At the height of the crisis in April, May, when I think people started looking at gold once again, one of the reasons that people said you should buy gold in India is because the rupee could collapse. Because the Indian economy is doing far worse than, most of the economies of our size and larger. And I was hearing views that the rupee could actually go all the way to 85, 87. Maybe that was the extreme sort of tail view, but there's a lot of negativity about the prospect of the rupee.
I am bearish on the rupee from a longer term perspective, Rahul, especially after the next quarter's numbers start rolling out. So let's say September ending quarter numbers are out. We've more or less accepted the fact sentimentally that it's going to be horrible numbers. But once the December numbers are out, remember your festive season buying would have come and gone. So Diwali, Eid, and even Christmas, etc., would all have shown up in the sales figures. I have a feeling that is the time when the markets will actually start to either have already given up or start giving up the exuberance that they are showing today. It's actually surreal. I'm seeing the markets and the prices around me, and I think things are completely out of whack.
Yeah, they sure seem to be out of whack. Okay. Sarit, any more questions on the currency, etc., before we move to the next point of discussion?
I think we can pivot to equities now.
Yeah, sure.
A lot of our viewers are waiting for Vijay's view on the stock market. So
he's shown his hands though just now.
Yeah.
What he expects.
So let's get Vijay's view on the broad market, as in the Sensex Nifty. Vijay, what are your charts telling you? You're a behavioral technical analyst. So how does that play into the stock market?
So, Sarit, from a behavioral point of view, the one thing that I've learned early on in behavioral finance is no amount of coding or pushing will get an older guy out of his easy chair and to get all fired up to do something new. And there's no power in the world which can rein in or subdue a youngster from going out to the beach and having fun. So one is bubbling full of energy, the other's completely cautious, very, very guarded, extremely measured in their approach. I have a feeling the recent stock market spike has been caused by the younger, energetic, guys who've got a lot of expectations from the markets. And over a period of time, you have to realize that the younger guys have definitely substantially lower amount of wealth as compared to the senior guys. The senior guys have exhausted all their ambitions and exhausted all their desires to possess material things, buy kids or cars or houses, etc. They've had a lifetime of savings and disposable income to play around with in the market. And I'm talking to a whole lot of guys, 50 plus, 60 plus, and they're all waiting to sell. They're all waiting to sell. And the younger guys may be larger in numbers, but individually have far less money to sustain a mark-to-market loss of the types that you've seen on Monday and Tuesday in the stock market. So they get cleared out once the broker starts debiting their accounts, and the back office department, or what is known in the broking industry as the risk department, starts knocking out people's long positions for non-payment of margin calls. I think a lot of these guys will simply get pushed out of the market. And as far as levels are concerned, I remember in one of our editorial meetings, I'd stuck my neck out and said, if you give me 12,500 on the Nifty, I don't mind pledging my house and shorting them. That feeling still holds. As a matter of fact, I think 12,500 is also looking stretched. I do caution viewers who are watching this video. I'm not the kind of guy who squares up his positions very fast. So if you think this is a day trade, you're completely mistaken. Watch the movie, what's that? The Big Short. The guy actually nurses his shorts for a while. So does Dr. Michael Burry. Yeah. So it's this kind of short that I'm talking about. Something that you don't get pushed out or nervously forced out in a hurry. You sit on your positions, you nurse them, collect your cost of carry because you're a short seller, and you simply ride the market down.
Yeah. So it's a bearish call, I think, that you're making.
I'm bearish in the markets, Rahul. Yes.
Yeah. Earlier today, I was watching a Bloomberg video where they interviewed Dr. Talib. He was in Lebanon, and they did it over the video. And he basically made the same case as what you were saying, where he said that he doesn't think the US will retain its reserve currency status the way it does today. And all the money that is being pushed in can only push things up for a limited while, right? All this liquidity can drive market. But ultimately, he said that there is nothing bigger than the market. The ultimate verdict of whether stock prices go up or down will be decided in the market, and it will not be decided by the Fed. And he was basically making the case that all this pump priming that is happening with the Central Reserve banks is not going to go down well. It's only going to create bigger issues down the line. And I think that's what we have to guard against, right?
I completely agree with you, Rahul. Ultimately, the markets are supreme. Amongst the Gujaratis, the Gujus, there is a saying, Bhav Bhagwan Che. Ultimately, price is God. Now, I have a feeling, and I'm not just saying it from my gut, it's from talking to people. I use video calling extensively. Thank God for technology. You can talk to people for free all around the world. So why not keep your ears to the ground and collect inputs from people who put their money to work in the markets. I mean, I'm talking to people, even the most exuberant ones are somewhat, cautious here in the back of their heads. They're saying, look, we know this market is going up because of steroids. And it could come down any time. Yeah. We just hope that we can get off the merry-go-round before it's about to stop.
Yeah.
So everybody has that fear that this market is up on steroids. They all know it. It's just a matter of who starts selling first. A couple of big guys start exiting, it's going to cause a crowded exit.
They're all dancing. They're all dancing, and they think they won't be the last when the music stops, right?
Exactly. There's a James Bond movie, I think Spectre, and the guy tells James Bond, Mr. Bond, you're a kite dancing in a hurricane.
That's right.
The bulls are currently like kites dancing in a hurricane. I mean,
it's a nice
very
metaphor.
risky right now.
Yeah. In fact, Sarit, when we spoke to Jim Rogers a couple of weeks back, didn't he say that he's buying the dollar because he expects that 1 year from now, the flight to safety will make the dollar stronger, and that's why it may make sense to own the dollar?
Yeah, Jim was of the view that the dollar, at least in the short term, will get stronger. A, because there's no replacement for the dollar on the horizon. And B, whenever there's chaos in the market, everyone rushes into the dollar as a flight to safety. Yeah. And we've seen that this week already.
Yeah.
So that was his view, that it always makes sense to hold some of your assets in US treasuries. So that will act as a buffer and as a safety net. So I'm not sure if many Indian investors do that, but in India, of course, we do it with bank FDs, and of course, the people who generally invest in bank FDs, as Vijay said, the older guys, they have been facing a double whammy because interest rates have been falling steadily for quite some time now, and they're quite low. So on one hand, we have the markets which may be topping out. We don't know, but we could see a bearish phase. And on the other hand, if you try to park your funds in a fixed deposit, you're not going to get too much out of that anyway. So it's a difficult situation out there.
Yeah, and Vijay was sharing that in our internal group the other day, right? When the SBI further cut its deposit rates.
Yeah, they have, yes.
It's
not a good situation for savers, right, Vijay?
Not a good situation, Rahul. As a matter of fact, from December 2019 itself, I have been recording videos in the Fast Profits Daily saying the year 2020 is going to be horrible for fixed income investors. And there is a fallout of that happening. Now, you're a fixed income investor. You expect 100,000 rupees as monthly income from interest. That goes down to 80 and then falls to 70. You're not going to skip a meal. You're basically going to try to compensate by taking a higher risk. So you edge people out of low risk investments into higher risk investments, like say equities, which is why you saw over the last 3 or 4 years' time, people putting in lesser and lesser money or even withdrawing money from debt funds and going into equity funds because that's where they thought, remember, return on investment and return off investment. Debt funds give you return on investment. Equity funds give you return off investment, your capital appreciation. They thought that they would make higher amounts of money from capital appreciation than the loss due to lower interest. And now suddenly the capital is depreciated. And then you take money out and put it in a bank FD, you're getting 5% odd as taxable. That's a double whammy. And it's the guys who write out the checks in the market who moves the needles and gauges in the markets, like say prices. Now these guys, if they stop writing out checks, you'll suddenly start to see a whole lot of people learn. I'm sorry. You'll suddenly see a whole lot of people learn that lower interest rates may be good for the borrower, but they're definitely not good for the saver. And the saver can hit back by stopping to write out checks.
Yeah, it's a manipulated system which favors the guy who's levered and who's willing to punt, and not the guy who's conservative. It's just the way the world works. But here I would like to mention something which I think is very critical, is that as interest rates have fallen, all of us are coming into contact with relatively wealthy people and not so wealthy people who want to earn a higher yield, right? And they're all saying, is there a way to make 8%? Is there a way to make 9% per year? And they are not accepting the fact that I think even the HDFC bank rate, which you can take as relatively safe, I think the 1 year FD must be 6% taxable right now, roughly there. So I think it's very important for the listeners to understand, don't chase the yield. I think that's the phrase, don't chase the yield. Your risk appetite is a given. Don't take more risk than that just to make extra return, because like Vijay said, you may tip from a safe instrument at 6%, you may end up in equity. Not only will you not get a return on capital, you may not even get a return off capital, and that's going to be devastating. So unfortunately, that's the reality. You don't have appetite for risk, you have to adjust to a lower yield, in my view. It's bad, but it's the hard truth, and I think it's the right thing to do. Cut your expenses if you have to, but don't take on more risk, especially in these times, right?
Absolutely, Rahul. I think it's of paramount importance that you prioritize capital preservation.
Yeah.
Today, capital is your holy cow. You can't afford to sacrifice it because it will rob your freedom to invest and trade tomorrow.
Yeah.
I would love to invest money in the safest possible instruments, even if I have to sacrifice the yield. Like, for example, sovereign guaranteed bonds. I know the President of India is guaranteeing the safety of my money. And also remember, the government has the power to print unbacked currency to discharge its debts. It might run the printing press of currency printing press over time and pay me the money on my bonds. I might have to see erosion of my buying power of the rupee that I get from the RBI, but at least I would have earned interest for 3, 4, 5, 7 years, which will compensate for the erosion in buying power. But if I was to give this money in the hundi market or in a private mutual fund, private sector debt mutual fund, I could simply not get my money back. It's 100% write-off. So I'm not aiming for alpha. I'm not aiming for return on investment. I just want my money to be safe, my capital to be safe, so that it goes on to my next and next generation intact.
Yeah. I think very important message. Everyone, please keep that in mind when thinking about investing your money. In fact, Vijay, that is exactly what Warren Buffett said. I think it was at his AGM, where he said that he sees no problem in a central bank issuing more debt, because it can always repay that debt by just printing more currency. It may lose a little value, but you're sure the money comes back. And he made that statement in the context that Berkshire, I think on the 1st of May or whatever the date was, they had $110 billion of cash, of which almost all of it was in treasury bonds, in US treasuries. So, there's a lesson in there. The smartest guy in the world, investor in the world, puts his money in treasuries. He's okay with that 0.25% return, but he knows he'll get his capital back.
I completely agree, Rahul. If we are talking of calendar year 2020, assuming I have 1 lakh rupees as all the money in the world that I own, in 2021, 2022, I would want it to be at least 1 lakh. Definitely not less. I don't mind if it doesn't appreciate for the next 2 years. That's okay. I'll feed myself from trading profits, intraday trading profits. That's fine. But whatever I have saved at the age of 54, I can't go back to the drawing board and start from zero all over again. I put a moat around the capital that I've already created all this while. I can't see it depreciate. So
preservation is key. Preservation is key.
Yeah. So Vijay, for our viewers who might not have this moat around their capital, how would you suggest they go about it? What are the investments they should consider to ensure capital preservation, and how much should they be even looking to allocate to such investments, these safe, guaranteed investments?
Sarit, day before yesterday, I recorded a video of how much you should invest in trading. That I said, take a number 75. That's the time when I think you'd want to hang up your boots and retire and have fun with friends and have cocktails in the club.
Maybe sooner, Vijay.
I'd love to do that. I intend to do that. Probably at 70. Why not? So I'd like to worry about what I'm drinking in the evening rather than where the stock is going up or going down.
Yep.
Right. So that is a 0.0. That's where I want to be. And I deduct my present age from there, 54. So 16% of my money should be in trading because it's extremely high risk. Then majority of the money should be in low risk. And I think you can't get any lower than sovereign guaranteed investments. So your public provident fund is a sovereign guarantee. Your sovereign guarantee bonds issued by the RBI are sovereign guarantee guaranteed by the President of India. There are post office schemes for senior citizens, etc., which have this guarantee. So get into these schemes. Even if you were to sacrifice the yield as compared to private sector bonds or corporate fixed deposits, I think this is a time when you don't want to risk your money. The fact that you're addressing people who want to invest substantial amounts of money in fixed deposit, I make the assumption that they are 50 plus. At that age, you can't afford to start life afresh. Your body is slowing down, your mind is slowing down. You may want a lot of things, but your stamina is running out. So this is the time to play safe. Sovereign debt and sovereign investment paper is where to go.
I think that's an important message, that your sacred money has to be invested in sacred instruments. Don't mix that up. Okay, let's talk about COVID. You got all the calls right with COVID. You even went out of the market. I think you made the last trade you made was in March, and after that you made a trade in June. You said this market is gone wacko. It's better to save capital than to go and punt in the market because the chance of losing money is high. How is this COVID environment playing out now, and how do you see it play out in time to come?
So when I go out there to colleges as a guest lecturer, and my wife tells me before I leave home, don't scare the children. Because that's what I keep telling my kids, and they are frankly not really very happy for what they hear. So I tell these kids, if you ask your father or your grandfather, they have joined the company as a junior accountant and retired after 25, 30 years with a gold watch and a farewell party as a senior manager. There was job security. Companies are around for donkey's years. Nowadays, startups have survival rates of less than 2 years. And 75-80% of startups simply fold up. So job security to youngsters is going to be very flimsy. Population has grown in the last 30-40 years. So increased competition. Thirdly, when I was a management trainee student, I was told that I would or I should dare to dream of retiring only when I had at the present prevalent rates of expenses, 25 years of forward expenses in investable cash. If I had saved that much money and the value of the house or the office was not counted, I'm talking of liquid investments. When you have liquid investments, that can pay for 25 years of forward household expenses, bare bones survival expenses, then dare to dream of retirement. And I asked them what happens to inflation. They said, look, you're going to keep this money in a bank fixed deposit. And believe me when I tell you this, the bank FD rates were 14 to 15% per annum in the 1980s and very early 90s.
Mm-hmm.
So you could basically plan your retirement. Look at today's children, college graduates. They're taking jobs at pathetic salary levels. The job security is almost absent. The companies that they work for can shut down overnight. Like I said, today you don't need to have a television broadcasting rights. You can simply go over the top, have a YouTube channel and have a few lakhs or a few million subscribers, which is what a lot of people are doing. Is technology is disrupting. And the FD rate is 5%, taxable. So if at 15% rate of interest on a bank FD, you needed 25 years of forward expenses before you dare to dream of retiring, how many more years do you need to add to 25 before you can dare to dream of retiring at 5% interest? I think the younger generation, which is coming out of colleges today, will never live life the way you and I have lived. We've had a cushy life, but to the future generation, we've saddled them with debts that they will break their backs paying with unbacked currency, which we keep on printing at the drop of a hat. So these are debts which my children and my grandchildren are going to pay, and I feel sorry for them. And they can't even dare to dream of retiring because they'll get 5% rate of interest, which I'm sure is going to go down lower by the time they get commercially viable entities in my house. So the future generation is not going to have a happy time. So if you're asking me post-corona, what's going to happen? This is what's going to happen. I mean, I see a lot of younger kids I meet in the park when I go down for a walk in the morning. They ask me, what's the next big buy? You know, children of my friends and kids I know from my club, etc. They look, that's all we have to do anyway. We have nothing else left to do. We just buy and sell stocks. That can't be a career. That can't be the only thing that you can do.
Scary. It's a scary outlook, Vijay. You're not listening to your wife. You're still giving us all scary outlooks. But I think it's important for that view to emerge because for those of our listeners who are very optimistic, you have to always allow for a certain degree of probability that things will not go right, and that's how you should always plan. I did go back to Talib's interview, which I saw this morning. The tail risk is something you should always plan for. And the tail risk in India is what if the story doesn't turn out like how most people believe it to? You know, we're all optimists. Indians are optimistic, right? Nothing, now things are relatively better, but 25 years ago, nothing worked. And yet we believed India is the greatest country in the world, right? We are just optimists, diehard optimists. But we have to plan for the tail risk that something may go wrong. And I think incrementally, even if I look at the RBI data, Indians are starting to invest abroad, right? In a small way. They're trying to hedge their risk. They're trying to diversify out of this. So I think in some way that's planning. That's good. Any other comments on this, Sarit, from you? Before we move to our last point of discussion, which I'm really excited about.
No, nothing from me. I think we can take it forward to
Sure.
the
Take
point
it away. Yeah.
we are waiting for. Yeah.
Mm-hmm. So okay, Vijay, there's no, like we always say, it's not for no reason we call you India's #1 trader, right? And when we look at your weekly cash alert service, where you try and generate cash regularly by doing high conviction trades, we noticed that you've now gone a year without a loss-making trade. During this period, you've had low single-digit returns. Very recently, you had I think a 15-16% return in a couple of days, maybe. I think that's something that is exceptional. So, talk to us more about how how you did it, and maybe give us some tips on how our listeners who are not following you very actively can try and implement some of those learnings and probably get a better track record?
Well, Rahul, I'll be honest with you. I've borrowed a lot of ideas liberally from a whole lot of areas. I'm a big fan of combat maneuvers. And air combat maneuvers excite me a lot. And trading is nothing but civilized combat. You don't use guns and tanks and submarines. You use a mouse and a keyboard. But believe me, it's warfare. Every guy out there and millions of traders smarter than you, richer than you, with a faster internet connection, with more capital than you can ever dream to have, are trying to take your money away using the stock or the commodity markets or the currency markets. So I planned it like combat. Now, I've heard this term, stay hungry, stay foolish. But what I did was stay paranoid. I was paranoid about following things to the T. I'm a big fan of hedge funds because hedge funds are what we call alpha boys. Alpha is pure profit. Whether the market is up or down, the hedge fund manager is not allowed the luxury of saying, look, the market is going down, so I can't make money, or the market is going to go up and I'm short and therefore I can't make money. He said, look, he's told, this is the market, this is the money we are entrusting you with, show us the alpha. The market could even be sideways. You have to generate money. Now, I borrowed from the hedge funds, their trading philosophies. I borrowed from air combat aces of the Second World War. And we used a liberal sprinkling of statistical data that are homegrown models that I've been working on for the last 13 to 14 years, purely statistical. So in a nutshell, I'm going to tell you what I did. This is a secret sauce, if you want to call it that. Number one, I use the Jensen's measure. Now, statistically, Jensen's measure is something that mutual funds and hedge fund managers use. It tells you that if you're going to take an additional unit of risk, it is justified only if it will yield a minimum of 2 units of additional reward. If it is not going to do so, potentially, I know potentially, there's no guarantee in the markets, but potentially if the Jensen's measure reading is not 2, don't touch it. Which means we let out a lot of trades, we deliberately missed out on a lot of trades and took only the high probability ones. Secondly, I again borrowed from the mutual fund and the hedge fund industry a concept called the efficiency frontier. So using the same amount of money, how could I return to my investors and subscribers higher profits, or with lower amount of money, how to generate similar amount of profits, which means you're deploying your capital increasingly and progressively more efficiently. The third aspect that we basically incorporated into what I did in the last 11 and 12 months, which is what you're saying has resulted in an unbroken string of profits, was that we basically went out there and traded only when we felt the market was going to reverse from some point. So, for example, crude oil prices jumped up after the Saudi facilities were attacked by drones in September last year, and crude oil prices jumped temporarily. Now, I felt this was an unjustified jump, and I even recorded a video with Equitymaster saying, no, the Saudis did not bomb their own facilities. This is a bona fide terror attack and prices will fall. We waited till the 11th hour and 59th minute before recommending a short on crude. And hey, if you check the performance table, you were out in 48 hours with superlative profits. So we waited till the last minute. Now, there was an air ace in the Second World War of South African descent, but in the Royal Air Force, Salem Allen. He said, when I go up there in the air to shoot down German aircraft, I do not pull the trigger or push the trigger of my wingtip cannon unless I can see the whites of the enemy combat pilot's eyes, which means I get
So
into
close to it.
extremely close range before firing my guns.
Mhm.
We waited and we deliberately resorted to brinkmanship and saw to it that we struck only when the iron was extremely hot and probably not going to get hotter. So this was a deliberate move, and I think we are getting better and better as we learn from the statistical model that is throwing up ideas. The whole point is that you throw out ideas which are just not worth it. It's like distilling vodka. Vodka is one of the purest types of alcohol you can have. It's distilled a minimum of 3 times, and some of the premium stuff is distilled 7 times. So every time you distill it, the impurities are removed and purer and purer stuff is left out. So we basically start cutting out trades that are lower probability or mid probability and take only high probability trades and then go out and trade. So the idea is, if you cut out the losses and continue to trade, what should mathematically and hypothetically be left is a profitable trade.
Yeah. So I'm going to try and risk using a metaphor here. So it's like not using a bazooka, but using a sniper rifle.
Exactly, Rahul. I mean, you basically have to be extremely cautious. Like I said, I was paranoid. I was looking at things that sometimes I felt I was even imagining. For example, I've shared with you in many videos, I have a gallery of 12 to 14 people whose statements I watch like a hawk. Names like Muqtada Al-Sadr, Ali Al-Naimi, Shakib Khalil, Rafael Ramirez, Nicolas Maduro, all these guys, Bijan Namdar, Zangane. Now, when I was recommending a trade in oil or crude, I mean, I was paranoid. I was checking on the internet if any of these guys have issued any statement. I was like a thief or a robber or a bandit looking behind my, looking over my shoulder and seeing whether the cops are following me. I was so paranoid whether I was doing things that could be hit by an unexpected news event or something that I didn't know. It's mentally taxing, but it's paying off fairly well. And I do feel that the law of probability will state that nobody can have an unbroken track record of wins. So probably a next loss-making trade might just be around the corner. But here I would like to add that we've also tightened our damage control techniques using statistics, which is why probably when we do tend to go wrong, it will be a smaller hit.
Yeah, yeah. And I do recollect you writing this somewhere and mentioning it, that you actually expect the next 1 year to be phenomenal in the way your charts are setting up in terms of profit opportunities.
I think so, Rahul. Provided you're extremely selective in what you're doing, I think the markets are so emotionally charged. Let me share with you one thing that I learned from my video chats with people over the weekend, and I have friends all over the world, which I'm very thankful for, which is where I get a lot of inputs. You would think that an average Indian is emotional and they don't take decisions with their minds but with their hearts. You will be surprised at the high level of emotions that is present in the Western financial markets. This happens because people are scared. I was watching a video of a leading US news channel where people are driving in A and B segment cars for free meals. And those cars are, of course, bought on installments. And a couple of them, school teachers and all, were even crying. They said, look, I don't know how to pay the EMIs of this car, but I need to give my children some food. So here I am, waiting 2 hours in a queue for free food. Now, obviously, under duress of this magnitude, you're going to think with your heart, which means we as traders in the market are also likely to take emotional decisions. Look at what's happening in the hurricane season in the US. You've had a hurricane called Beta, which has devastated parts of Texas. There's knee-deep water in places. Roads are unmotorable. People are worried about where their next meal might come from because everything is disrupted. Under such circumstances, money is the only comfort that you can look forward to. Of course, assuming that there has been no loss of human life in your immediate family. And if money is not forthcoming from jobs and Robinhood traders are making money, you might just go out there and jump into the trading ring without actually being adequately prepared. So the markets are going to be very, very emotionally charged over the next 1.5 years, which means to the guy who's seen it all, has the experience, waits like a butcher with a knife to catch the next fat goat coming in front of him to slaughter it.
Mm-hmm.
You have to be extremely selective. You can put good amount of food on the table provided you are willing to wait. This is going to be a very selective game. So I think instead of taking the 5 and 8 and 10% return trades all the time, you wait for the 30, 40, 60 and 80% profit potential trades. And just do 2 or 3 of them and you're set for the year.
I think that's a great approach, and I'm so glad you explained it to all our listeners and viewers today, because I think there are lots of takeaways there which can help them become better traders. So thanks for that, Vijay. Sarit, you have any follow-up questions for Vijay on this?
Yeah, I think Vijay has delivered almost 43% return in the last financial year for his subscribers. So I believe in one of our podcasts, he mentioned that he is confident of doing even better this time, and he's definitely still confident about that right now.
Yep.
And it's important, like he said, don't play for the 5 or 6% returns. There could be many such opportunities, but the risks are just too high. Wait for the fat opportunity, the one which can give you a big 20-30% payout, and when the risk is already in your favor. That makes a lot of sense. So on that note, I would like to ask Vijay in conclusion, are there any more such nuggets of wisdom that he can provide to our viewers? I mean, yes, you have more than 34 years of experience in the markets, and now you're seeing a lot of these Robinhood traders come in and try and punt on stocks on the margin. So what would you say to all these newbie traders? I mean, is there something they can do to protect themselves or to learn to become better traders?
Absolutely, Sarit. I shared on my social media pages on 6th of September a screenshot from the NSE website. It's called the NSE dashboard. If you Google search it, you will find it. It's a PDF file and it's updated every month. It's the return versus the volatility that the Nifty 50, the Bank Nifty and all other sectoral indices have returned over the past 1 month, 3 months, 6 months, 1, 3, 5 years. It shocked the life out of me that over the last 5 years, the Nifty has returned 8.76% per annum. But to earn that 8.76% per annum, you would have to take a volatility risk of 31%. When you're risking 31% of your capital to earn 8.76%, remember what I said about the Jensen's measure. You take 1 additional unit of risk if you're confident that you will generate 2 additional units of profit. Here, you're taking 31% volatility risk to earn 8.76% on the Nifty index. So obviously, the pot of gold at the end of the rainbow does not lie in the indices. It's in the individual stocks. And when you're playing with individual stocks, the ball game is completely different. The Nifty will not move more than 1.5% or 2% in either direction on a day-to-day basis. But an individual stock can go to 5, 6, 8% on an individual day. And if you're a day trader who's leveraging in futures, a 6% move can kill you overnight. Which means that to be able to survive, and not just survive, you need to thrive. To be able to survive and thrive, you have to be faster, better, smarter, and quicker than the average guy in the market. I keep telling people that we traders don't need to lift weights or box with an opponent. We basically fight with a mouse and keyboard. So to that extent, we are brain warriors. The guys whose ideas are bigger and better take the money of the guys whose ideas are weaker and less worthy of being traded upon. So you're basically going to be using your head to make money. Your head had better be full of good ideas, which means risk, as Warren Buffett says, does not lie in doing something, but risk actually lies in not knowing what you're doing. So I think what you need to do is educate yourself in the business of trading and take it very seriously as a highly competitive business so that you can put food on the table for your family, which means spend some money on training courses, which means hire professional subscription services like Equitymaster's various plans that they have for mid cap, small cap, large caps, whatever. Till the time you don't garner enough confidence, experience, and skills, you can't really afford to bleed your capital dry.
Yeah.
So more and more knowledge, more and more finesse. You have to get savvier, you have to get quicker. That's what I would tell the newbies.
Wonderful. So on that note, Vijay, thank you very much for taking the time out. Faster, better, quicker, right? That was the key message. If you want to become a better trader, that's what you guys need to be doing. Thank you once again. Sarit?
Thanks a lot, Vijay. I mean, every time we speak with you, it's always a very enlightening experience. And this time,
Enlightening, big time.
Yeah, this time I think you spoke a lot more, personally, and you shared a lot of, words of wisdom that will, help a lot of our viewers. And I thank you for that. We are always grateful to have you on the show, on our show. And perhaps you could, grace us again, perhaps few weeks or few months down the line again.
Yeah.
Thank you so much, Sarit. Thank you, Rahul, for having me. And I always look forward to being with you on this podcast.
Thank you. Signing off. Thank you, guys.
Thank you.
Bye.
Thank you. Thank you. Bye-bye.
Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.